All right, good morning, economics class, fourth block, principles of economics. We are going to summarize and extend our study of Unit 3, which is the big picture, talking about GDP, inflation, unemployment, different types of unemployment, the business cycle, aggregate supply and aggregate demand. We've started talking about the Federal Reserve Bank system, and I want to spend most of the time today's lessons talking about the Federal Reserve Bank system and how that impacts our economy, what role they play, how do they accomplish their goals, what are their goals. I know you've watched two videos on the Federal Reserve already, the crash course number 10, I think it is, which is about 10-minute introduction to the Fed, and then the longer, the Fed and You, which is put out by the St. Louis Federal Reserve Bank. And so this is going to summarize that, and I'm going to extend it a little bit further because there are two policies we want to talk about in this unit. One is monetary policy, and that is the Federal Reserve, and the other is fiscal policy, and that is the government as opposed to the Federal Reserve. They're two separate things, remember. How the government can change their spending and their taxing practices to impact the economy, right? So a good place to start is with our business cycle chart. Remember that the economy goes up and down. In the short run, there are peaks when business activity is strong, everyone has a job, economic GDP is growing, we are at a high point in the economy. And so everyone is growing, and it's kind of a dynamic economy. Obviously, it expands to that point, and at some point it takes a downturn. Things slow down for various reasons, and could enter some sort of recession or just a slowdown. And then at some point, at the bottom, there is higher unemployment. Inflation is not a problem. GDP is not growing very much. And from some point like that, the economy starts to go up again. So this is over time. The expansions and contractions are the terms we'll use of how the economy changes over time. Remember, at the peak, at the top of the business cycle, the problem is inflation, right? Prices could keep going up as people have a lot of money and keep buying, demanding stuff, goods and services, with all the money they're making with this very dynamic, robust economy. Everyone has a job and GDP is growing. Those two are good to go, but the problem at the peak is inflation, prices going up by excessive demand or cost, prices going up because cost of natural resources are going up since they're scarce. And then at the trough, at the bottom of the business cycle, the problem is unemployment, right? Problem is not economy so slow, people get laid off jobs, kind of like what we're experiencing now, that people don't have jobs. Inflation is not a problem. Prices are going down. If you've seen gasoline prices or some other cost of things recently, they've gone way down. And GDP is not growing, so there's slow growth or negative growth, could be a recession or even a depression. But at some point, things change and the business cycle starts to pick up steam and grow again and head to another peak. So what the government is trying to do, what the government and the Federal Reserve is trying to do, is moderate the peaks and moderate the troughs, right? They want to lessen the peak moment when they want to take care of inflation, slow things down at the peak, right? So they're going to try to mitigate the extremes of the peak And during the trough, they're going to try to mitigate or lessen the degree of slowness or recession, or contractionary. They want to try to mitigate these extremes of the cycle, right? So they want a more steady growth. Remember, the Federal Reserve, there are two main roles or goals, or they call them mandates, that the Congress has given the Fed, is to manage inflation and try to provide for full employment. I guess they manage inflation and provide for full employment, the economy will grow. So those are their two main mandates. And so take care of inflation at the peak, take care of unemployment at the trough. So mitigate those fluctuations, extreme fluctuations of the business cycle. Okay, so that's the Fed. The Federal Reserve is has their certain tools, right, to try to accomplish those two goals, right? Low inflation, high employment, low unemployment, right? So they have tools. How do they do that? Well, let's talk about the Fed in general first, and what they are and how they operate. As most of you know by now, the Federal Reserve is the central bank of the United States. The central bank, the government's bank, the bank that serves the whole country. It's a private institution, semi-public in that it is created by Congress, but it is not funded by Congress. It's funded by the interest they earn on all the government securities that they hold. It's a very powerful institution. It is. They control monetary policy. They regulate the banks, right? And they manage a check payment system, right? If you write a check for a purchase, it has to clear. That check goes into a sort of clearinghouse, and then those funds are taken out of one account and put into another account. So that's done by the Fed. They have this sort of whole back office sort of operational check clearing processes. Much of it's done computerized and digitized and like that, so it's very automatic, but it's a massive, billions of dollars and millions of transactions every day that they do. Obviously, they regulate the banks, the Federal Reserve banks. Not all banks are Federal Reserve banks. Some are state banks, but they're all overseen and managed to varying degrees by the Federal Reserve. And they have inspections and they have reports that these banks have to provide them for, to make sure they're not taking too many risky loans, that they don't have too many bad loans, that their investments are appropriate and safe. So safety and liquidity are two important things that the Fed wants to maintain. So the safety, the people have confidence in their banks, and their banks aren't going to go under, right? Now, of course, we've got, nowadays, we've got something called the Federal Depository Insurance Corporation, FDIC, and those adds a lot of confidence to the banking system because, why? Because they insure our deposits at the bank up to $250,000 per person. So that covers most of us. And so there's no fear that if the bank is going under, there's been some problems, some bad loans, something causing the bank to fail, we don't have to run and get our money because it's guaranteed by the government, right? Okay, so, and remember, supply and demand, the more there is of something, the cheaper it is, right? The less there is of something, the more expensive it is, right? And we talked about credit and people borrowing money. So if you want to borrow some money, you're going to pay an interest rate, right? You want to buy a car, you're going to get a student loan, you're going to get some business loan. You're going to pay 5% interest, 10% interest, and 15% interest, depending on your credit and your history. you're going to have to pay an interest rate. But remember, the interest rate is the cost of borrowing funds, either from the bank. And the banks borrow funds from the Fed. And the Fed sets certain interest rates, target interest rates that either encourage the banks to borrow more money from the Fed if the rates are low. If the rates are high, it discourages the banks and us too from borrowing. So if the Fed wants to slow down the economy, they'll pull money out of the system, out of the economy, right? Less money, cost of money goes up. That means interest rates are going to go up, and the economy slows down. People stop borrowing as much, spending as much. A lot of people borrow to buy big things like washing machines and cars, and, homes. So if the interest rates are high, that's going to slow that down, right? Due to there's less money in the system, right? So the cost of money would go up. That would happen at the peak. At the trough, the Fed would want to stimulate the economy. And to do that, they would provide more money in the economy. More money, greater supply of money is going to lower the cost of money, right? Supply and demand, right? There's a big supply relative to maybe what it used to be or demand, then the price is going to go down. The price of money is the interest rates. So interest rates would go down, people would borrow more, business would invest more, banks would loan more, and economic activity would be stimulated, right? So that is the way monetary policy, it's like turning off and on a faucet, right? Water comes out, you want more water, more money, more liquidity in the system, or you want less. Turn the spigot off, less money in the system, interest rates go up, things slow down. So that's basically, in a nutshell, monetary policy. The Federal Reserve, it's what we call a decentralized central bank, right? It has a central office in Washington, D.C., where the 7 governors are stationed. That's where they operate. Remember, 7 governors of the Federal Reserve. They're appointed by the president, approved by the Senate, as any appointment is, presidential appointment is, and they serve for 14 years. 14 years. So they have long terms, right? Longer than a president. So they sort of try to be non-political, right? Non-political. A Democratic president may appoint a governor who he thinks is aligned with his philosophy. Well, eventually there may be a Republican governor and they're stuck with those Democratic earlier appointed governors, but that's the way it is. They're trying to set it up so that it's not kind of a political football, right? So, 7 governors, 12 branches. The central office, the main office is in D.C., and then all throughout the country. I think you've seen that map on both of those videos. They show the districts of the 12 Federal Reserve districts. And we're in the 6th district. And Atlanta has a Federal Reserve Bank. St. Louis has a Federal Reserve Bank. Cleveland has a Federal Reserve Bank. San Francisco has a Federal Reserve Bank. New York has the main central, I guess you call it regional bank, regional district in the United States, because New York City is the financial capital of the world. That's where Wall Street is. Money, the large banks operate out of New York City. So New York City is kind of a main district. Boston has a district. I think New Orleans has a district. Dallas has a district. There's all these different districts, 12 districts, right? And they report and monitor the banks in their district, report on those banks, report on the economic activity of their districts. And so there are 12, I guess you'd call presidents of these 12 district banks. And they are part of what they call Open Market Committee, Federal Open Market Committee. The committee meets, 8 times a year, every 6 weeks, to decide which kind of monetary policy we're going to have. what kind of monetary policy is needed right now. And they change that policy at every meeting, right? Or tweak it or whatever they need to do. So the 12 presidents of the region, of the district banks, the 7 governors all meet, and there's a lot of staff and whatever, people that meet with them every, 6 weeks? They meet 8 times a year. It's about every 6 weeks, and determine how is the economy doing. What the Fed has done recently has massively provided funding to the economy, right? Trillions of dollars they poured into these banks to lowering interest rates. Interest rates now are very low. The target interest rate that they target is something called the Fed's funds, and the Fed's fund rate, and that is about 0 right now. That is the rate that banks lend to each other for overnight reserves that they need. And so it sets as whatever the Fed's fund rate, then other rates line up with that. If that goes down, other rates go down too. So the prime rate, the bank's loan rate, the discount rate, which is the rate that the Fed charges member banks, that goes down. So it's all tracks this Fed funds rate, and that is the rate that is tweaked every 6 weeks by the Federal Open Market Committee when they decide, what is our target rate for right now? And they have lowered that rate quite a bit lately to help this economy, right? And that's about all they can do. The government is working on fiscal policy, right? They are spending more, they're providing funding for relief, and so there's some transfer payments going on. So that's fiscal policy, but we're talking about monetary policy with the Federal Reserve, right? So 12 branches, 12 districts, 12 presidents of those district banks. They meet, they're part of this Federal Open Market Committee, and they decide what do we want, a contractionary fiscal policy, contractionary monetary policy, slow the economy down, or expansionary monetary policy to stimulate and provide liquidity to the economy. Obviously right now they're in a very expansionary mode, right? So remember that the Federal Reserve is independent. There's been a lot of controversy about the Federal Reserve Bank. Remember Hamilton and Jefferson, the whole play Hamilton is all about whether or not we should have this central bank. Is it too powerful, or not? And certainly having gone through the Great Depression in the 1930s, the Great Recession in 2008 and 9, and the current situation that we're in, people are thankful that there is a Federal Reserve Bank that can sort of monitor the economy and provide the funding and the stimulus or anti-stimulus depending on the economy. So very important and very valuable institution. Right? All right. So let's talk about banks. How do banks make money? Banks make money by taking our deposits, which they get kind of for free, right? They don't have to pay us any interest. We just give them the money that we want to just park there until we need to spend it, right? And millions of people give their money to the banks. And so the banks have this huge pool of money that they don't need to have all of that money on hand. A lot of people hold balances in their checking account. And they have a $100 balance or $500 balance or $1,000 balance in your checking account. And that's going to fluctuate as you write checks and charge things on your debit card, right? So the banks have this huge pool of money, and they just don't hang on to it. This pool of money doesn't cost them very much. Some money is in the forms of savings accounts. People give the bank money as a saving account, and they may pay 1 or 2%. It's a very low interest rate. But they can take all that money, not all of it, but about 90% of that money, and loan it out. They can make business loans, they can make student loans, they can make car loans, they can make personal loans, they can make credit card loans at a very high, much higher interest rate than the cost of their money coming in, right? That's how the banks make money. So they say their average rate on their loans and investments might be 10%, right? And their cost of money might be 1%, right? So they're making that difference on carrying the spread, and that's called fractional reserve banking, right? The Federal Reserve Bank system sets something called the reserve requirement. The reserve requirement right now is about 10%. Banks have to hold 10% in reserve. They can't loan it out. They can loan out 90%, but they have to hold 10% for day-to-day operations, right? You're going to come in, you're going to want your money, you want some cash, they got to have that cash available. And they can hold that cash in the vault, or it can be in the form of deposits at the Federal Reserve Bank. That money is not in the economy. It's being held in reserve for safety, really, right? So 10% reserve requirement. Sometimes the Fed can raise that reserve requirement if they want to kind of slow things down, make it more difficult for banks to make loans, or they can lower it. It went from 10% to 5%, then banks can make more money, and that sort of creates money throughout the system. How does that create money throughout the systems? Well, say you get the bank gets a deposit, they can loan out $1,000, they can loan out $900 of that, right? Hold 10%, $100 back. They can make a loan for $900. So they make a loan for $900. Someone gets that $900 as a loan, and they're going to maybe invest it or buy something with it. They may buy something with it. They may put it in their bank. Eventually, that $900 is going to find its way back to another bank, right? Deposited in another bank. Well, that bank can say, we got $900. Okay, we need to hold 10% of this. We'll hold $90 of that, 10% of the $900, and then they can make a loan for $810, right? And that's the process goes on and on. The money, any new money that comes into the system gets multiplied as it ripples through the economy. And so if the reserve requirement is like 10%, that money would be multiplied about 10 times. So $1,000 would create, quote unquote, create new money in the economy 10 times that amount. So $10,000, right? So this is the way through fractional reserve banking. So a fraction of the deposits are held in reserve, that the banks create money, and obviously the Fed can raise and lower that reserve requirement to either stimulate the economy or slow down the economy, right? It doesn't do that very, very rarely. The main way that the Fed will stimulate or slow down the economy is through something called open market operations. And the Fed and You video talked about this at the end there, where the banks and the Fed have a relationship. The big banks that have, billions of dollars in securities and investments and deposits, these large banks and the Fed have a relationship. And when the Fed wants to provide money to the economy, to stimulate the economy by lowering interest rates, by increasing the money supply, they will buy the government securities from the banks, right? The Fed buys government securities from the banks, and the banks get all this money, which they can now go loan out, right? If the Fed wants to slow down the economy, say at a peak, then the Fed would sell these banks a bunch of government securities, right? And when the banks buy those government securities from the Fed, they have to pay for them, right? So they lose money. Money is taken out of the economy as the banks pay for those government securities, right? So this is called open market operations. It happens on a daily basis. Millions, billions of dollars are traded between banks and the Fed every day. and they're tweaking it. Should we put more money in the system? Okay, we put more money in the system, we'll buy your bonds and give you money. We want to take money out of the system, okay, we'll sell you our bonds and take your money out of the system, right? So the Fed plays that formula every day, right? And lately they've been buying assets from the banks, financial assets like government securities, even some loans and things like that, to give the banks more money to keep interest rates low, to encourage people to spend money and invest in economic activity, right? So that is pretty much the story of the Fed. The Fed is an important institution. Remember, they regulate the banks, so they're inspecting them, making sure that they're safe, that they have enough liquidity, and they don't have a whole bunch of bad loans. They clear checks, right? Which is electronic transfer, billions of dollars every day. It's kind of like bookkeeping, you know, keeping track of the money flows, okay? Giving it to this bank, taking it to this bank, all these transfers. Every time we write a check or a debit card, you know, it's electronic transfers of all these funds between banks and accounts at different banks, right? And then the big thing is managed monetary policy. So remember, the Fed is very independent. Right now, many of you watched the video. You saw that Janet Yellen used to be the head of the Fed. Ben Bernanke was the head of the Fed before her. And the current head of the Federal Reserve is a man named Jerome Powell. He was appointed by Trump, but remember, the Fed is very independent. And side note, my great-great-grandfather was also head of the Federal Reserve. He was the president of the Atlanta Fed, and during the Great Depression, he was taking carloads of money up to the banks in Nashville, so they would have liquidity, they would have funding for their customers when when the banks opened on Monday morning, because it was bad news. People thought the banks were going to fail. So my great-great-grandfather was, as president of the Atlanta Fed, drove to Nashville with a bunch of cash to give these banks to provide them liquidity during this crisis. So we have a Fed here in Atlanta. It's on Peachtree Street in Midtown of Atlanta, and you can go there and take a tour and see how they print money, how they shred money, old money. They take out the old bills. And remember, the Fed controls the money supply. The Treasury Department actually prints the money, and the coins get stamped at the mint, U.S. Mint. But they're all very closely related, but the Fed doesn't necessarily print the money. I might check that out. Anyway, that's pretty much what I wanted to talk about. Let's talk about, you can stop this video and come back and watch it a little later, but I want to take it one step further and talk about, very briefly, fiscal policy. Fiscal policy is the government, the federal government, Congress, and the president managing spending and taxing rates, basically, to impact the economy. Remember, you have two separate things. You've got the Fed, which is independent, and it does monetary policy, and you've got the government, Congress, and the executive branch that do fiscal policy. Fiscal means taxing and spending, right? And they also want to mitigate the low lows and the high highs, right? And how would they do that? Fiscal policy, well, spending and taxing, and also transfers, you know, things like Social Security, Medicare, Medicaid. Right now, you know, they say the government's supposed to be sending households checks for $1,200. You know, that's a transfer of assets to people, and they do to businesses sometimes too. All these loans, small business loans that they're talking about now. So the government can either increase their spending to stimulate the economy. They could lower taxes to stimulate the economy, right? If tax rates go down, people have more money, more disposable income to spend, right? If taxes go up for businesses or corporations, right? Corporations and individuals have less money to spend, the economy slows down. Congress does not like to raise taxes, and that's sort of politically not very, good thing to do because you won't get elected again. But spending, government loves to spend even money that they don't have. Remember, if they spend money that they don't have, it's called deficit spending, and it creates annual deficit in the federal budget as well as adds to the national debt long term. So, fiscal policy by the Congress and the President, by the government as opposed to the Fed. Spending, increase spending to stimulate the economy, decrease spending to slow things down. They don't do that much, but they should. When things are really good, stop spending, pay off some of the national debt, but the government has a tendency just to keep spending. That's why our national debt's about, 23, 24 trillion dollars. Also, we talked about spending and taxing, right? And transfers. They're going to use those three tools to either stimulate the economy. If they wanted to stimulate the economy, if we were in a trough, what would they do? They would lower taxes, right? They would spend more, government spending, as you know, is part of GDP, and they would increase transfer payments, right? And that would stimulate the economy. If we are at a peak, and the problem here is inflation, right? They want to slow things down. What do? Well, they're going to spend less. They should, at least. They were going to tax more. They should, at least. And transfer payments, they might decrease transfer payments. We talked about automatic stabilizers anyway. Things like Social Security and unemployment. Obviously, when things are good, people don't need as much unemployment, so that automatically stabilizes the economy. Or in a trough, people can apply for unemployment insurance. That's an automatic stabilizer, right? That will automatically kind of mitigate the peaks and valleys of the business cycle. All right, so fiscal policy, just know that's government spending and taxes and transfer payments. They can kind of have a contractionary or expansionary policy based on where the economy is and how they want to impact the economy. Those two work together, right? Sometimes they say monetary policy works faster, right? Because it can be implemented very quickly. And there's still a lag for the effects to be felt. But with fiscal policy, the government has certain things that they have to do no matter what. These are called non-discretionary budget, right? They have certain things that they have to pay, Social Security, Medicare, Medicaid. They don't have a lot of discretion on a lot of the budget. But the part of the budget they do, maybe 50%, is called the discretionary budget. And they can tweak that, increase that, decrease that as needed. So fiscal policy, monetary policy work together. Fiscal policy does take a little longer because you've got to go through Congress, you've got to pass some spending bill, and then it gets approved by the president, and then it gets implemented through some department of the government, and then it impacts the people, and it impacts the market. So the lags are a little more with fiscal policy. So monetary policy is kind of more immediate and maybe a little more effective. But right now, interest rates are so low, there's really nothing more that the Fed can do in terms of interest rates, lowering interest rates. Money supply provides so much liquidity, money in the system that they can't lower rates anymore, unless they start paying us to borrow money. And that doesn't really happen much. So the banks are just, providing funding, as much funding as the economy needs to get us through this period here. Anyway, that's pretty much the story on fiscal policy and monetary policy. And so listen to, glad you watched this video, and I will pose a few questions to assess your understanding. All right. Hope everyone's safe, and hang in there. We're gonna have a little summary questions on this unit, and then we're gonna talk about last unit is probably going to be personal finance. There are actually 2 more units in our course, but I don't know if we'll do much. We may talk about exchange rates a little. That's an international kind of concept, and then we'll also maybe talk about personal finance, things like insurance, credit cards, credit scores, budgeting, banks, and things like that. So stay safe and stay in touch.